Today we will start with derivative analysis and valuation chapter. Okay, we are covering this chapter from Ajay Agarwal sir's concept book. Okay, so before we start the chapter, we will see an example. Okay, what is derivative contract? Okay, so a derivative contract is a contract between two parties. Okay, so what is it specifically? We'll see. Let's suppose a share, that is NHPC share. It is a PSU undertaking. Okay, the share is currently traded in the market at the price of rupees 83, let's suppose. Okay, so a person A, okay, he is a very optimistic person. He is saying that after 3 months this shares price will go up. Okay, this shares price will go up by how much? By 17 rupees, and it will reach how much? 100 rupees. Now person B is saying no, you are not saying this right. Okay, there are many factors in this economy and I don't think so it will go up. Okay, so he's a pessimistic person. He's saying that the price will go to 70. Okay, now they both are arguing. Okay, now what's happening is that a third person, let's suppose a person C. Okay, a person C is coming, and he's saying what? He's saying, okay, you place a bet of 50 rupees. Okay, and he asks person B to place a bet of 50. Okay, both of them have put their money, and C is the person who is taking care of this transaction. Okay, so the C person, he tells that, okay, I am a trusted person. Okay, I will charge a certain commission. Okay, he will charge a certain commission so that nobody cheats on another. Okay, so he charges a commission. Let's suppose one person, okay, he charges his commission. Okay, and 50 plus 50, they have put the money in the bet. Okay, now whoever wins take the prize. Okay, now after 3 months what happens is that the share price did not reach 100 rupees. Okay, it reached only 95. Now B is saying that since the price reached only 95, I will not give the full amount of 50. Okay, you take 47 rupees, or the amount you do pro rata basis, and you give me, and I will only give that much amount. The amount which you told, that is rupees 100, did not reach, so I will give only pro rata basis. Okay, that is B is saying. Okay, and C also agreed that yeah, that is quite possible, because the bet was only for how much? When the price reaches 100. Okay, so this is what happens in the futures market. Okay, this is known as derivative contract. Means what? They place a bet. Okay, it is simply known as betting. Okay, in legal terms it is known as derivatives, but it's actually betting. Okay, they are betting that if price goes up, I will give you the money. If price goes down, the other person will give the money. Okay, so this is the basic thing. You have to keep this in mind. Okay, now what is A purchasing? A is purchasing long. Okay, A is doing long, and what is B doing? B is doing short. Okay, B will earn when the price goes down, and A will earn when the price goes up. Okay, simple betting. Now we will see the concept. Okay, now this chapter, derivatives analysis and valuation, it is divided into 5 parts. Okay, so what we will do, it is the first part is your introduction to derivatives. Okay, the second part is your equity derivatives, that is your forwards and futures. Okay, equity derivatives for forwards and futures, and the third part is your options. The fourth part is your swaps. Okay, and the fifth part is commodities, which is not that important for us. Okay, sometimes it comes in exams, but it is not that important. We'll focus on these two parts, second and third part. Okay, mainly we'll focus on that. Okay, so first I'll give some introduction to derivatives. Okay, so what do you mean by derivatives? I have already told you that it is simple betting. Okay, meaning of derivatives. Derivatives are contract between two parties. Okay, between two parties, which derives its value from underlying asset. Okay, so what was the underlying asset in our case? It was NHPC share. Okay, so this outcome of the contract depends on the asset. Okay, underlying asset. Okay, so that is what is written here, that it depends on the price of NSPC share. Underlying asset can be equity share, commodity, currency, interest rate, etc. Okay, equity we will learn in this chapter, commodity we will learn in the 5th part, and currency we will learn in forex chapter. Okay, and interest rate we'll learn in IRRM chapter. Okay, so now why is a derivative contract entered into? Only for two purposes. Okay, the first thing is the for doing transaction on a future date, and the next thing is betting. Okay, betting of price, sorry, for betting on price of an underlying asset on a future date. Okay, so what does doing transaction on a future date means? Okay, let's suppose you have a land. Okay, you are eyeing on a land, the land's value is, let's suppose, 2 crores. Okay, now you want to purchase that land. Okay, but you know that within 6 months there is a national highway project that is going on in the nearby. Okay, I'll just write and show it to you. See, there is a plot. Okay, there is a plot which is rupees 2 crores. Okay, now you want to buy this. Okay, on 1st January 2026. Okay, now you want to buy this plot. Okay, but you don't have the money right now, but you know that in 6 months, okay, in 6 months the price of the plot will be 2.50 crores, because there is a national highway project going on in the neighboring area. Okay, that's why its price is going to rise, but this owner does not know. Owner A does not know. Okay, so now what I will do is that I will say that I will buy from you from 36. Okay, on 36 I will buy from you. Please, but I don't have the money now. I will buy on 36. Okay, I'll pay you 2 crores only. Okay, now the landowner is saying, do I look like a fool to you? Okay, why should I fix the price right now? Okay, I will sell it to you in the future only. So he's saying that, no, I will sell it to you in this price, 2 crores, but I will pay interest also. Okay, at the end of 6th month, okay, I will pay interest to you. Okay, so 2 crores plus, let's suppose, 10% interest. Okay, so I will pay you 2.1 crores. Okay, he is saying that on 36 I will pay you 2.1 crores. Okay, now he has made a contract. Okay, on 36 he has to execute the contract. Okay, he has to pay 2.1 crores, and when the price is 2.50, the landowner should not say that I will give you for 2.50 crores. Okay, no, he will have to pay it for 2.1 crores only, because he has made a contract here. Okay, so this type of contract is known as what? Is known as settlement by delivery. Okay, now the second type is your for betting, that is for betting on the price of the asset. Now this person, he does not intend, okay, this is for land, no, this is for a commodity. We'll talk about share, because share is the main part of the syllabus. Okay, so share we have already discussed, that is 2 person are betting on the price, they do not have the asset. Okay, they are just betting on the price. Okay, the price will go up or down and they will get the gain from it. Okay, this is known as what? This is for betting. This is also a derivative contract. So in this case, in the second part, in the NHPC share case, they both do not wish to buy the asset or sell the asset. Okay, they are just invested in the price of the security, purely betting. Okay, they do not need any asset. Okay, so in this case they settle by cash. In the first case, what is happening? In the land case, they are settling by delivery. They are delivering the actual product. Okay, now Mr. A has to purchase the asset at the price of 2.10 crores at the end of the time. Okay, in this case he only settles by cash. Okay, so it is known as cash settlement. Generally cash settlement is done in on derivative contracts. Okay, now participants in the derivative contract. Okay, now who does a derivative contract? Okay, who enters a derivative contract? The first thing, the one who has greed, जिसको लालच है. Okay, the one who has greed. And the second one, who fears a lot, the डरपोक आदमी. Okay, the one who has greed, and the one who is fearful. Okay, only both of them enter derivative contract. How? I will tell. Okay, so the first one is a speculator. A speculator is a person who just watches the share. Okay, he is not interested in the company. Okay, he is not interested in what the company does, and he doesn't interest in the shares. Okay, he is just interested in the price of the share. Okay, they do not have any existing exposure but want to earn profit by betting. Okay, they do not have any share with them. Okay, so there is no risk. Okay, if they have share, there is a risk. Equity shares are risky, right? Equity shares do not have at the beginning of the time. Okay, they just want to buy it for earning profit. Okay, so what is happening here is that they want to earn profit, so that's why they are entering into derivative contract. They do not have any asset. Okay, so there is no risk from the first starting period. Okay, so they do not have any existing exposure but want to earn profit by betting. Okay, so these are the greedy people. Now who are hedgers? Okay, now hedging is a good concept. This we will learn in the third part. Okay, sorry, in the second part. Sorry, it's in the second part only. Hedging concept we have. Okay, that time I will explain it to you in the detail. Now just listen to me. Okay, let's suppose a person. Okay, A is a person who is having NHPC share of rupees 83. He has having one share only. Okay, now what is happening is that he has bought the share, but it is a time of what? It is a time of World War. Okay, now he is expecting that in 2 months World War will happen, so my price will be heavily going down. Okay, I will be going in loss. So what he'll do? He wants to hold the share. He does not want to sell immediately. He wants to hold the share, but he is very fearful. Okay, so what he does is that he buys a future contract. Actually, it is sell. Okay, he sells a future contract. Means what? He takes a short position in the share. Okay, let's suppose at 83. He took a short position. Now, what happens is that in future, if the price goes down, by having a sell contract, short contract, he will earn profit. When the price goes down, he earns profit, right? But if in the future, if the price increases and he has taken a short contract, then also he'll face loss, right? But here what is happening is that he is minimizing his loss. Okay, he is making his loss near to nil. Okay, so this is known as hedging contract. Means what? Whatever he is afraid of, he will take that position. He is afraid that the price will go down, then he will take a short position. If he is afraid that the price will go up, he will take a long position. Okay, so this is known as hedging, taking opposite position than what we have. Okay, if I have a short position, I will take long position. If I have long position, I will take short position. Okay, so this is known as hedging. And who are arbitrators? Arbitrators are scalpers. Okay, those do not have any existing exposure like speculators, but wants to earn riskless profit by taking advantage of mispricing in the market. Okay, arbitrage in what happens is that there are two markets in India, NSE and BSE, right? In NSE, the price is, let's suppose, of NHPC price, NSE and BSE, right? In NSE, the price is of NHPC share is 83.05. Okay, in BSE it is 83.02. Okay, now what these people do is that they buy from NSE and sell it on BSE. Okay, where there is less sorry, they buy it from BSE and sell it in NSE for a higher rate. That is, they will get only 0.03% profit. Okay, this is not actually possible because the stock exchange takes commission and there will be no point in doing that. Okay, still it happens in some place, but they do it by using bots. Okay, computer bots they use, they call it as algo trading, but we do not have any syllabus, so we'll not discuss. Okay, these are the main three types. Next, classification of derivatives on the basis of underlying asset. Okay, so as I told you earlier that equity, IRRM, interest rate, currency, commodity, other derivatives, credit, weather, electricity, etc. Okay, I already explained it to you. IRRM deals with your interest rate, we will see in the later chapter. Currency derivatives is a forex. Okay, now the types of derivative contracts: forwards, futures, options and swaps. Okay, in this part we will do only forwards and futures. Okay, and this is our part 3 and this is our part 4, right? So part 2, forwards and futures of equity derivatives. Now what do you mean by forwards and futures? See, this forwards and futures, they both mean the same thing, but there is a simple difference. Okay, a person is sitting here, another person is sitting here. Okay, this is person A, this is person B. Now they both are going to make a contract, future contract, like this person, like this case. Okay, over the counter, this is the counter. Over the counter they are making a price, they are making a contract. This is known as what? This is known as forward. And what is future? It is, they will both go to, they will go to a person called as Grow. Now who is a Grow Limited? Grow Limited is your broker. Okay, he is a broker or DP, right? He is a DP. They will go to their broker and they will ask for future contract. Now this grow person will will make him meet with the another person, but he will not tell the name. Okay, he will just take the information of long from here, and from here he will take information short. Okay, and they will, and the broker will let them play. Okay, so this is known as futures contract. Okay, this is the basic difference. Forwards and futures are equity contracts in which underlying assets is equity. Okay, share or index. Okay, index means was, index means your Sensex and Nifty, right? So forwards and future contract are same, except that forward contract is done over the counter and futures contract are done on a stock exchange. Okay, so what does Grow act? Grow is a broker who connects us with the stock exchange, right? These contracts create obligation on both the parties on the contract. That is, each party of the contract has to fulfill their promise. In each case they have no choice. Okay, once the contract is made, they cannot back off. Okay, they have to fulfill their promise, they cannot do scam. Now price of forwards and futures. Okay, now we are going to do pricing. Okay, now we are going to find out the value. Now in security valuation chapter, what we learned is that we learned valuing the securities, your equity, bonds. Okay, we learned valuing securities. Now here we will try to value future contracts, if the future contract is accurately priced or not. Okay, so the first one is, what is the theoretical fair value or fair value of future contracts or forward contracts. Okay, it is also known as cost to carry model. So what we do is that we have three methods here. Okay, what are the three methods? The first one is your simple interest method. What is your simple interest method? It is your P into R into T. Okay, we have already learned this, principal into rate into time. Okay, so that is what is given here, right? So S into 1 plus R into T. Okay, This is simple interest. Now what does R mean? R means your rate of interest, and T means number of days. Now rate of interest, we have to take it here annually and not per month, okay, or per day, or the whatever the time is given. So we have to take it per annum. And time factor we have no, so in that we will do number of days divided by 365 or number of months divided by 12. Okay, this we have to do. Next we have is F is equal to, now we have continuous compounding interest. This is the second type. Okay, so what do you mean by continuous compounding? It means that your price will go on compounding every day. Okay, it takes every day into account. So for that, S into this 1 plus R into T, no, we are writing is as ERT. Okay, I don't know the meaning of E, but this E value will be given in question. Okay, this R into T we have to do it, right? So how do we do R into T? R into T is your interest into tax. Okay, so above normally we have to do. Okay, let's suppose your let's suppose my rate is 3%. Okay, and my time is, let's suppose 2 months. Okay, so what will I do? 0.03 into 2 divided by 12. Okay, now here what answer will I get? 0.03 into 2 divided by 12. I'll get 0.005. Now E005, 0.005, this it will be given in question. Okay, so we have to use it. Okay, in question sometimes they give 2 to 3 rates, so we have to do this calculation very good. Okay, so we need to know this calculation. Okay, so S into this value, let's suppose it is given 1.006, so let's suppose our S is 151, so 151 into 1.006, so it will be 151.906. Okay, so like that we have to calculate. Next we have is monthly compounded interest. So how do we do monthly compounded interest? It is the same as your simple interest, but here one thing is happening. It is that your time will be in raised to your 1 plus R. Okay, 1 plus R raised to T. S into 1 plus R raised to T. So here what will happen is that you will take interest rate for the per month, and then you will take time totally. Okay, number of future months. Okay, so how you will do? Interest rate, let's suppose 3%, 3 divided by 12. Okay, into your T. Let's suppose it is 2 months, into 2 months. Okay, so when we do multiplication, we'll do into -1, right? -1 times we do. If it is 2, we'll do just into 1. If it is 4, then we'll do into 3 times, right? Next, there are some notes given here. If dividend income on underlying share or index is given in question, dividend income is given, then what you have to do is given in the question in fixed amount. Okay, let's suppose dividend is given as rupees. Okay, rupees 4. Okay, or percentage is given on face value. Let's suppose 40% of 10 rupees. Okay, so 4 is my amount. Then deduct PV of dividend amount from S in the above formula. So what we'll do is that we'll do PV of dividend amount, okay, for finding out the current price. So simple interest, if it is given in simple interest, how we'll do? Dividend income divided by 1 into R plus R into 1 plus R into T. Okay, and if it is compounding interest, dividend income divided by ERT, or if it is in multiplication, it will be minus RT. Why is it? Because this ERT, when it goes in multiplication, it becomes minus. Okay, whatever thing is down here, if it goes in multiplication, it becomes minus. Okay, and monthly compounding, it is 1 plus R raised to T. Okay, dividend income divided by this. Now number of days or months after which T is your number of days or months after which dividend income will be received divided by 365. Okay, next we have is if income dividend income on underlying share or index is given in yield percentage. What is yield? Yield is your DPS divided by MPS, right? So how much dividend yield are you getting? So then deduct dividend yield rate y from interest rate. Okay, so let's suppose your yield is 3% and your interest rate is 9%. So 9 minus 3. So this will be your interest rate, right? It is the same logic, KE minus G, right? So we'll do that. Next, which type of interest is to be applied? That is simple continuous compounding or monthly compounding, specifically given in question. Okay, for compounded compounding interest, how it is given: compounded continuously. Okay, compounded continuously, interest rate is given in question, then apply continuous compounding interest. If interest rate per month or interest on monthly rest is given in question, then apply monthly compounding interest. Okay, otherwise apply simple interest. Most of the questions will have simple interest. Okay, next, above calculated price is theoretical fair price of the future. Okay, so F is equal to S into 1 plus R into T, or F is equal to S into ERT. Whatever you calculate, it is your theoretical fair value. Okay, but your actual quoted price can be a little different. Okay, it is not mandatory that your intrinsic value is equal to your face value, right? Sorry, intrinsic value is equal to your actual market value, right? Like the same. Okay, your theoretical fair price need not be equal to your actual quoted price. Okay, on future. Now I need to explain some concepts to you, okay, so that you have better understanding. What do you mean by futures? Okay, there are two market, spot and futures. Okay, if you have traded in Bitcoin, then you might know this concept. Futures is a different market, and spot is a different market. Spot means what? Spot means your long term or delivery. In futures, what happens? There is only cash settlement. Okay, both these market are different. Okay, so we are trying to find this, both price will not be same. Okay, so now what we are finding out is that futures price, how much it should be. Okay, spot price is, let's suppose, 83. Futures price will be 83.06. Okay, so this is what we are going to find. For that, we are having this thing. Okay, theoretical fair value we are finding out. Okay, now what is contango backwardation? It is your S minus F, your spot minus your future. Okay, if your spot is more than your future, then the market is going in the backward direction. It is known as backwardation. Okay, if it is negative, then it is normal. It is your contango market. Okay, only one question we have this. It is very much easy. Okay, I'm not gonna solve this example. Okay, now we have is price of one future contract or lot. Now this future contract can be on anything, right? So index is just a number. Okay, but on that also betting can happen. Okay, we will consider, let's suppose, what is the Nifty right now? Your Nifty is 26,000, right? Your Nifty is 26,000. Now we will consider this as rupees, right? So now what is your one future contract or lot? Now they are saying is that if you want to enter into a contract, into a derivative contract, okay, if you want to enter into a contract, then you have to buy how much? 50. Okay, so this is your one contract. It should have how much? 50 units of Nifty. Okay, so 26,000 into 50 is equal to your one contract. So what is lot? Lot is your number of contract into lot. Okay, let's suppose you have one contract and you want a lot of 3. So okay, so you have how much? 3 lots, but in it how much is it? Into 50. So you have 150 units in it. Okay, so this is the concept of future contract or lot. Okay, so now what is your contract value? Yeah, this is your contract value, 150 units. We have 150 units, no, into number of, into the share price, unit price is equal to how much? 150 into 26,000. It is 39 lakhs. Okay, so what we have done is your contract, number of contract into lot into number of units, right? Sorry, into your unit price. Okay, price 26,000 into number of contract 50 per contract into 3. Okay, so that's what we have done. This is your, see, price of one future contract into number of contracts or lots. Okay, I have explained it to you better. Now gain or loss or payoff. Okay, in our question they would have given payoff also. It means the same, gain, loss or payoff on future contracts. So how do we do? It is simple basic logic. But here it is there is a concept, so I'll just explain it to you. It is calculated by squaring off the contract on maturity cash settlement as follows. Okay, whatever the language it is, I don't understand. I'll tell you the logic behind it. If initially wrong position on future is taken, okay, means what? You have taken buy futures. Now it means what? It means what? It means upside betting. In this case, price of one future market, we have done upside betting, right? So if the price goes up, we are in profit. If the price goes down, we are in loss. Simple as that. If it is in down short position, then that means what? If the price goes down, we'll profit. If the price goes up, we will make loss. Okay, so how do we do? Number of contracts or lots into lot size into difference between the future on maturity and initially contract price. Okay, or contract value into rise or fall percentage in the price of future market. If you did not understand, I'll tell you. Now 26,000 we had, no, so we made a long position. Okay, now the price went to 26,500 after 3 months. So 26,500 minus 26,000, my initial price, okay, into number of lots. How much was it? It was 3 into how many units each had? 50. So we will get the answer. So 500 into 3 into 50. So we had a profit of 75,000, right? If it was percentage fall, okay, 26,000, okay, plus 3% increase, okay, so it is 27,780. 26,780 minus 26,000, then we'll get profit. Okay, so how much is it? 780 into your number of lots into number of contracts into 3 into 50. Okay, it is 117,000. Like that they would have given a question. We will see the question and we will understand it. Okay, this is the basic funda. It is very much logical. You can do it. Okay, you just have to keep this in mind. Okay, you have to keep your logic with you. Now we have types of margin in future contracts, future contracts. So what is it? First one is the initial margin. Initial margin means what? It is the amount which an investor has to deposit in the margin account with stock exchange to enter into a future contract. Okay, so what is happening here is that we are entering the market. Okay, we are entering the market, we are placing the bet. Now what he will do, whom are we placing the bet? Okay, to whom are we placing the bet? Grow. Okay, Grow is what? Grow is your DP, your broker. To broker, what you are saying is that broker is saying that if you want to enter a future contract, so what you have to do, your contract value into your initial margin percentage, you have to keep it. Okay, in question they would have given initial margin percentage. If it is given, well and good, we will multiply it with this, okay, and we'll get initial margin. Okay. Now if it is not given in question, then what you have to do is that mu plus 3 times your standard deviation. Mu means what? Your average daily absolute change in the contract value. Okay, your average value. And what is the standard deviation? Standard deviation is the average daily absolute change. Okay, that is the fluctuation. So what is he doing is that is playing safe. Who? The broker is playing safe. He is taking 3 times the standard deviation, okay, plus the average value. So that much safe they are playing. Next we have is the mark to market margin. It means what? Mark to market means your gain or loss. Okay, it simply means your gain or loss. We have to just calculate gain or loss, like I've told you in the previous part. Next we have is maintenance margin. What is maintenance margin? It means when the balance in the margin account, okay, let's suppose we had initial margin of 1 lakh. Okay, we had initial margin of 1 lakh. We have an example, but we will not discuss this. We will directly go to questions. Okay, it means we had 1 lakh. Okay, we had 1 lakh in the margin account. Okay, now what is happening? We are calculating the gain or loss. Okay, now the loss, now maintenance margin percentage, it will be given in question. Okay, maintenance margin percentage will be given in question. Okay, they would tell us, okay, if it is based on initial margin price or contract value, whatever it is, we'll see. Okay, let's suppose you did your in question it was given 80% of your initial margin, okay, into 80%. Okay, so 80,000 is your value. Okay, now what is happening is that we have 1 lakh. Okay, now we had a loss of 10,000. Okay, we have 90,000 left in the margin value. Okay, next day what is happening is that we again have a loss of 15,000 now. Now what will the broker tell us is that, see, I told you that margin account should not fall below 80,000. Okay, since it is falling below 80,000, what you have to do, you have to replenish the initial margin account. So what will the broker do? The broker will call money from us. Okay, he will say pay 15,000 more to trade further. Okay, to trade for a further day. So 15,000 more, sorry, not 15,000 more. He'll ask for 25,000 more because the initial margin amount was 1 lakh. Okay, so we have to replenish the amount to initial margin amount if the amount falls below minimum maintenance margin. Okay, so how do we do it? There is a format. First we have to do date, opening balance and margin amount, mark to margin, that is your gain or loss, balance and margin after adjusting mark to margin, call money, and then we have closing balance. Okay, so when we do questions, I'll explain it to you. It is very much easy. Okay, now we'll do questions. Okay, section A, pricing of futures. Question number 1 we have, it is very much easy. Just put the formula, you will get the answer. So what is given here is that 6 months future price of a security is 208.18. The borrowing rate is 8% per annum, payable with the monthly rests. Means what? Monthly compounded. Means what you have to do? 1 plus R. 1 plus R. How do we calculate R in this? 8 divided by 12. Okay, because we have to take monthly. Okay, plus 1 into how much period is it? 6 months, right? So we have to multiply it 5 times into into 1, 2, 3, 4, 5 into what I have to do? 208.18. This is my spot price, right? Sorry, this is my future price. No, I have to divide it. 1. 208.18 divided by, so we'll get 200 as the price. 200.04 we are getting the price. Okay, here it was a reverse calculation question. It was given, future was given here. We have to find spot price. Okay, Next we have is question number 2. On 31st August, okay, 31st August, the value of stock was 2200, index was 2200, the risk-free rate has been given as 8% per annum, the dividend yield is given. Okay, now what you have to do is that dividend yield percentage is given. Assuming that the interest is continuously compounded daily, find out the price of futures deliverable on 31/12/2025. Okay, E value is given. Okay, now what they are telling us is that it is interest is compounded daily, right? It is compounded daily. Now what you have to do is that since it is compounded daily, now what you have to do is that S into ERT, right? That we have to do. But here dividend yield is also given. Dividend yield we have to minus it from the interest rate, right? So what you have to do is, it is given for how much? 31/12 it will be ending. On which date are we here? On 31st August we have here. Okay, so from August, 31st August. So from September 1 we will calculate. Okay, so why have they given this all these data? To confuse us. Okay, from January data is given to confuse us. So we will take only this amount. But how do we calculate? 3 minus, we'll take individual figures or what? No, we will take average of it. Okay, so 3 plus 4 plus 3 divided by 4, right? So 3.25 is my dividend yield minus my 8. Now we are getting what? 0.0475 as my interest rate, right? Effective interest rate minus, that is yield, interest rate minus your dividend yield. Okay, now this figure I have. Now what I have to do is that we have to multiply it with the number of months. Okay, so into what? So ERT, no, so T we have is 4 months, right? That September, October, November, December, 4 months, into 4 divided by 12. Okay, so 0.1583 will be my ERT, right? So 0.1583 is given in question as 0.01593. Okay, 1.01593 into my spot price. What is my spot price? It is 2200. So I got the value as 2235.046. Okay, 2235.046. I got the answer. Okay, it is very much easy. Okay, next we have is the topic of gain or loss, that is payoff of future contracts. Okay, now question number 3 is given. Okay, this is a good question. Okay, so what is it? We'll see. Mr. SG sold 5 4 months Nifty futures on 1st February 2025 for 9 lakhs. Okay, so what is he saying is that Mr. SG sold 5 contracts, okay, of 4 months Nifty futures on 1st February. Okay, so at the time of closing, the means what? He is taking short position here. Sold means was he is taking short position on 1st February, okay, for 9 lakh. At the time of closing of the trading on the last day, that is on May, okay, for 4 months they are trading, no. So on May means what? He took it on February, March, April, May. So at the end of the May, what is happening is that the price turned out to be 2100. Now what they are asking us, the contract multiplier is 75. Means what? In one contract there is 75 units. Okay, so they are asking us what? The price of one future contract on 1st February. Okay, what we have to find is that F part we have to find. Okay, so what would have been the future contract value on 1st February? So how will we find it? How much did we buy it for? 9 lakh. Okay, so 9 lakh divided by how many contracts did we have? We had 5 contracts. Divided by 5. Okay, in one contract how many units are there? There are 75. So divide by 75. I am getting as 2400. So 2400 is my what? Is my theoretical fair price. Okay, theoretical value. Now Nifty index on 1st February if Nifty index they are asking, okay, they are asking Nifty index. What we found is that we found future price. I told you no, futures and spot market they both are different. Okay, now they are asking us spot market. Okay, we found out future market as 2400 on 1st February. If futures value on the same date was theoretically correct, means what, the future value was right only. What we calculated 2400 was right. Okay, the future value was right, futures market price was right. On the same day, risk-free rate of interest and dividend yield was 9% and 6%. Means what, we have to, risk-free rate is given as 9% and dividend yield is given as 6%. So my effective rate is 3%, right? Now we have to find out the Nifty index. Okay, so how do we find it? Now what was the time period? So this was for per year, no? So for carry out calculation on month basis. So we'll carry out calculation on month basis. So how many months are we having? For 4 months, right? Into 4 divided by 12. So I'm getting 1% interest per annum. Sorry, per 1% interest I'm getting. Okay, for the 4-month period. Now what should be the value? Okay, so I'll solve it and tell you. See, now f is equal to s into 1 plus r into t, right? So this is my formula. Now they have given us future contract. They are saying that this price is right. They are asking us this price. Now s we don't know, into 1 plus r. What is my r? 3%, right? So 0.03 into my t. T is what? 4 by 12, right? So how much am I getting? 2400 is equal to s into 1 point. Now we have to do this multiplication first and then we'll add BODMAS rule. So 0.03 into 4 by 12 plus 1. So I'm getting it as 1.01. Now what will be my s? S will be 2400 divided by 1.01. So 2400 divided by 1.01, I'm getting it as 2376.24. Okay, this should be my spot price, right? So I got my spot price. Now what they are saying is the maximum contango or backwardation. Contango or backwardation, how do we solve it? It is S minus F, right? So on what? On 1st February. Okay, on 1st February they are asking. What? How do we calculate it? What is my S? 2376.24. What is my F? 2400. Okay. Now we have to calculate this. So I'm getting it as minus 23.76. Since it is in minus, means what, your future is more than your spot price, means what, the market is contango. The market is moving forward, means what, it is contango. It is more than your spot price, means what, it is contango. Okay. Next we have is the payoff on the transaction, means what, they are asking gain or loss. Okay, so how do we calculate gain or loss? Gain or loss, how do we calculate? So how much did we buy it for? 2400, right? How much was the price on end of the May? It was 2100 minus 2100 into my number of contracts into 75, right? Number of contract was 75. Okay, so how much do we get? We are getting for 22,500 for one contract. Okay, for one contract. But how many contracts did he have? He sold 5 contracts. So into 5. 112,500. Okay. So this should be my gain or loss total because he sold 5 contracts. See, 112,500, 2376. That is contango market. 2376 we got. Everything is matching. Okay. So just do simple calculations, you will get full marks. Okay, just present it accurately. Next we have is question number 4. Then we'll start with future contracts. Okay. Now question number 4. A future contract is available on R Limited that pays annual dividend of rupees 4. Okay. And whose stock is currently priced at rupees 125. Okay. So what is the yield here? 4 divided by 125. Yield is 3.2%. Right. Each future contract calls for delivery of 1000 shares. Means what? In one contract we have 1000 shares to stock in 1 year. Okay. So the time period is 1 year. Daily marking to market means what? It is being used daily. Okay, daily we have to calculate the gain or loss. The corporate treasury bill risk-free rate is 8%. Means what? Your interest rate is given as 8%. Now using the above information, calculate theoretical price of one future contract. So how do we calculate it? Okay, so the first thing what we have to do is 3.2 we had dividend yield minus 8%, right? So 4.8 is what is my effective interest rate into time period, it is 1. Okay, now you have to calculate theoretical fair value price. Okay, plus 1 means why did we do plus 1? It is S into 1 plus R into T, right? So R into T I did and plus 1 I did into what is my spot price? My spot price is currently priced at 125 into 125. So what is my future price? It is 131. Okay, now determine the price of one future contract if the company stock price decreases by 6%. Okay, since he bought it, means what? The price is decreasing. Okay, we need not calculate gain or loss here. First, determine the price of one futures contract. We have to determine the price of one future contract. Now the difference scenario they are giving. Okay, if the company's stock price decreases by 6%. Okay, means what? 125 minus 6% is happening. Now they are asking us to find out future price. Now what is how do we do it? It is S into 1 plus R raised to T, right? It's my pen. So what it is? S into 1 plus R into T, right? So this is my formula. So I need to find futures. Spot is given as 117.5. Okay, into 1 plus R is given in question. Yes, but we have to find out what? We have to find effective yield. Effective rate. Effective rate is what? It is how much? 8% minus your dividend yield. What is my dividend yield here? It is 4. Earlier it was 125, but now the price is 117.5. The things have changed here now. Okay, so how much will we get? So I'm getting 0.045 as my interest rate. Okay, so into 1 plus 1 into 117.5. So I'm getting it as 122.9. Okay, 122.9 rupees I'm getting as a future value. Now determine the amount of gain or loss as a result of the company price decreases for an investor who has a long position in one futures contract. Now he has taken a long position. Okay, means what? The price has reached 122.9, right? Sorry, determine the amount of gain or loss as a result of the company's stock price decreases for an investor who has taken means what? The price is 122.9. So earlier how did he take? Okay, so now what they are saying is that the price was 131. Okay, but the price went to 122.9 because it faced a decrease of 6%. Okay, so now 122 So how much did he face loss? Into 1000, right? In one contract. So he faced a loss of 8100, right? So that is what is given in question. Okay, means what they have said is that if the price decreases to 6%, how much will the investor lose? He took a short position, he took a long position here, right? He took a long position at the start of the period when the market price was 125 and the theoretical fair value price was 131, right? So 131 minus 122.9, so he got 8100 loss. Now question number 5 we'll do. Okay, now margins and future contract. Okay, so this margin is very much easy. Okay, it's very much easy. Okay, so I'll just solve question number 5. Question number 6 will be a homework. Question number 7 we have just 1 point, so I'll do that. So question number 5 is very much easy. Okay, I'll just tell you how to do it. See, on 31/8/2025, Mr. R has a long position of 2 lots of Nifty futures of 17300. Okay, he has a lot 2 lots, okay, of how much? 17,300 is the price of Nifty futures. One lot of Nifty future is 50 units. So how much does he have? 50 units into 2 lots. He has 100 units, right? So price of one future is how much? 17,300, right? So now initial margin required is 10% of the contract value. So what is my contract value? It is 17300. 17,30,000 is my contract value into what? Into my initial margin. It is 10%, right? And maintenance margin is 80% of initial margin. So what is my initial margin? It is 1730. 1,73,000 is my initial margin. Now what is my maintenance margin? It is 173,000 into 80%. It is 138,400. Okay, this is my maintenance margin. Now what they are asked us, the closing price of 5 days are given. Okay, prepare a statement showing the daily balances in the margin account and payment on margin calls. Okay, now they are asked us prepare a statement. Okay, so how do you prepare a statement? So first column is your date, the second column is your margin, opening margin, right? The third column is your gain or loss, that is mark to margin, mark to market, whatever, gain or loss. Okay, simply gain or loss. Okay, now we'll directly do calls and then we'll do balance. Okay, I don't like that after gain loss, I don't like it, so I directly put calls. Okay, so the first date on 31st March, what he had is that on 31st date, what he had, what is the opening margin? 173,000, right? What is the mark to margin? It was nil. Okay, on 31st March he did not trade. Okay, calls no, balance 173,000. Okay, we will carry forward it on 19. So what is the mark to margin now? What is the gain or loss on second day? The price of closing Nifty is 17,340. Okay, so 17,340 minus my initial price 17,300 into my number of units, 100 units, right? So how much are we getting? 17,340 minus 17,300 into 100. So I'm getting a profit of 4,000. Very good, profit of 4,000 I'm getting. So how much am I having? 177,000, right? The next day it will be carried forward, 177,000, and we'll calculate mark to margin. What is it? 17,180. 17,180. Now with what amount will I minus? with the previous day or the initial day. With the previous day we have to do minus. Keep this in mind. Okay, so 17,340 into 100. 17,180 minus 17,340 into 100. I'm getting it as minus 16,000. The first day had a profit of 4,000, but the next day into 4 times loss. Okay, minus 177,000. It is 161,000. Okay, our maintenance margin is how much? It is 138,400. Since we are not touched it, so it is fine. Okay, 161,000 is fine. For the next day, we can keep this amount. The next day, what is happening is that on 3rd, what is happening? I will take the balance now, 161,000. Okay, and now I will do mark to margin. 16,990 minus 17,180 into 100. Again loss. So how much loss am I facing? 16,990 minus 17,180 into 100. I am facing a loss of 19,000 more plus 161,000. Okay, now no call. Okay, 142,000 we will do because why? Because it is more than your margin amount, so no call is required. Now next date 4/9. If again there is loss, then we might have to call money. Okay, now next it is 6/9. 6/9, what is happening? 142,000 I carried forward. 16,900 again loss. 16,990 into 100. Again loss is happening. 16,900 minus 16,990 into 100. Loss of 9,000. Can I take it? No, it is going below my maintenance margin. What was my maintenance margin? It was 138,400. Okay, how much loss am I doing? Much more loss. 133 it went. Now I have to replenish my initial margin. Replenish my amount to my initial margin. Okay, what is my initial margin? It was 173,000 minus 173,000. So I'll have to call how much? 40,000 I'll have to call. 40,000 I'll call. So 173,000. Now I have replenished the amount. Now on 7/9, 173,000. I have replenished the amount. Now what is the profit or loss? 17,120 minus 16,900 into 100. Okay, now I have profit. 17,120 minus 16,900 into 100. I got a profit of 22,000. I need not call now. Plus 1,95,000. Okay, we prepared the statement, we got. Okay, now compute the gain or loss if the contract is squared off on 7/9. Okay, means what? He is taking out on 179. So gain or loss. So how do we calculate it? Opening minus closing. 17,300 minus 17,120 into 100, right? 17,300 minus 17,120. It will come ulta, okay? It will come ulta. 17,120 minus 17,300 into 100. Loss of how much? 1,80,000. Okay. Now what they are saying is that what would be the gain or loss if Mr. R had taken a short position? Prepare a statement showing the daily balance of margin in this case. So in this case, what will happen? The gain will remain same. Okay. He'll gain how much? Wait a minute. 300 minus 1. It is 18,000, okay, not 1,80,000 into 100 only, no. So 18,000. He'll gain 18,000. If he had taken a short position, he'll gain 18,000. But here what will happen is that they have also told us to prepare a statement. So to prepare a statement, what you have to do? Copy the same format. Just put this in minus and this in plus. Okay. So put plus, and here nothing will come, and then you have to do. Okay, same thing only. Okay, I'll just show it to you. Okay, the third one, whatever plus was coming, do it minus, and whatever minus was coming, do plus. Okay, then we'll get the gain. Okay, if we had taken short position. Okay, very much easy. Okay, question number 6 is your homework. Question number 7. Question number 7 is a little bit different. Okay, so here there are 3 figures given: high, low, and closing. So which one we have to take? Okay, take closing. We do not need high, we do not need low, we just need closing. Okay, so this is irrelevant. Okay, only this part is relevant. Your closing balance is relevant. So Abhishek bought 1 and 6 means what? He has taken a long position. Okay, the average daily absolute change in the contract is 10,000. Okay, means what? Mu plus 3 standard deviation is given here. Okay, so this is the only thing that was different in this question. So 10,000 plus what is my average standard deviation? It is 3 into 2000, right? So what is my initial margin? My initial margin should be 6,000 plus 10,000. It is 16,000, right? And what is my maintenance margin? Maintenance margin is equal to 75% into 75%. So 12,000 is my maintenance margin. Okay, rest all the question is very much easy. You can do it. Okay, so it is the same. You have to just calculate day changes in future value. That is your just follow my format. Okay, you will be able to get the answer. Okay, rest the question is very much similar to question number 5. You can do it very easily. Okay, call money, how much we have to take it, margin amount, closing balance we have taken here. Okay, so that's it for today. In the next lecture we'll cover hedging. Okay, till then, tada, bye bye, see you.